For most of us, debt is just stressful, right? You see those credit card statements pile up, you've got the car payment, the mortgage. It's this constant weight we're all trying to get out from under. It's supposed to hold you back. But what if I told you that for the wealthiest people out there, the complete opposite is true? And that right there is the huge paradox we're going to unpack. For a tiny slice of the population, living on borrowed money isn't a trap at all. Nope. It's actually a super sophisticated strategy to get even richer, to live pretty much tax-free, and to build massive generational wealth. For them, it is the smartest financial move they can possibly make. So, how is that even possible? How can the exact same thing, a loan, be a crushing burden for one person and an incredible tool for someone else? Okay, let's get into it because the answer really pulls back the curtain on a huge secret about how money works at the very top. All right, so it all comes down to this. There are basically two completely separate worlds when it comes to borrowing. And get this, it has almost nothing to do with how much money you make from your job. The real difference, the thing that changes everything, is whether you're borrowing against your income or borrowing against your assets. Okay, so this is the world most of us live in, right? We get a paycheck, the government immediately takes its cut for taxes, and then we use whatever's left to pay the bank, plus all that interest. It feels like you're getting hit twice. And from the bank's perspective, they're really just lending against your ability to keep showing up to your job every day. Now look at this contrast. It's pretty stark. On one side, you've got our debt. The bank sees our job as the collateral. And a job can be risky. So what happens? Interest rates are higher, and you have to pay down the principal every single month. The bank is kind of like your landlord. But look at the other side. The bank is lending against a solid portfolio of assets. For them, the risk just plummets, and when the risk goes down, so do the interest rate. And this really gets at the shift in the whole power dynamic. Think about it. A normal borrower goes to the bank and says, hey, I need money to buy a car. But a wealthy borrower says something totally different. They say, look, I already own all this valuable stuff. I just want to access some cash for a little while. The bank isn't sweating it. For them, it's just a simple liquidity decision. Okay, so how do they actually pull this off? Well, it's not random, that's for sure. It is a very specific, methodical playbook. So let's break down exactly what that playbook looks like, step by step. First, and this is the foundation for everything, you've got step one, build a base of assets that banks actually trust. Then, step two is all about borrowing a relatively small amount against what you own. After that, step three is where the real magic happens. You structure the loan for flexibility, not for a quick payoff. And all of that leads to step four, living on that tax-free cash from the loan. So what exactly are these trusted assets we're talking about? Well, it's not collectibles or a fancy watch collection, no. We're talking about productive things that grow or generate income. Think a big portfolio of public stocks, income-producing real estate, or maybe a private business that has predictable cash flow. From a bank's point of view, a diversified portfolio is super unlikely to go to zero. A person's job, well, that can disappear in a day. All right, let's use an example to make this super clear. Let's imagine someone has spent years building up a portfolio of these exact kinds of assets, stocks, real estate, the whole shebang. And it's now worth a cool $50 million. Now, they need some cash to live on, maybe for a few years, but they don't sell a single stock. Instead, they just go to their private bank and take out a loan for, say, $10 million. And this right here is the most important part of the deal, the relationship between these two numbers. It's called the loan-to-value ratio, or LTV. You can see they're only borrowing a fraction of what their assets are actually worth. In this case, that LTV is just 20%. To a private bank, that is an ultra-safe loan. I mean, there is such a massive cushion there. Even if the market has a bad year and their assets drop in value, the bank knows they're still going to get their money back. And because it's so safe, they get amazing terms. And here it is, the first really mind-blowing part of this whole strategy. That $10 million that just hit their bank account, the income tax they pay on it is zero, a big fat nothing. Why? Because legally, it's not income, it's debt, and you don't pay tax on the money you borrow. Okay, now we get to the part that honestly sounds kind of impossible the first time you hear it. It's not just about getting tax-free cash. It's about the fact that they often take out these huge loans with zero intention of ever paying back the original amount. So how do they do that? The secret is all in how the loan is structured. See,
With our mortgage or car loan, we're forced to pay back a piece of the principal and the interest every single month. But these special asset-backed loans can be set up as interest only. The only thing they absolutely have to pay is the annual interest. That's it.
So back to our example. They borrow that $10 million at, let's say, a 3% interest rate. That means their only required payment is $300,000 a year. And for 10 years, they just pay that interest. The original $10 million principal, it just sits there, completely untouched. So the big question is, what happens when the loan is due at the end of the 10 years? Well, they basically have two main choices. Option one is simple. They just refinance. They take out a brand new $10 million loan to pay off the original one, and the cycle just keeps on going. But option two is even more powerful, and it's what often happens. Let's say their assets have been growing this whole time, and that $50 million portfolio is now worth $100 million. They can now borrow more, say $20 million. They use $10 million to pay off the old loan, and boom, they walk away with an extra $10 million in tax-free cash. And the whole time, they never sell a single asset because that would mean a huge tax bill. This whole cycle, you see, can literally continue for a person's entire lifetime. But the final, and honestly the most powerful piece of this entire puzzle, comes at the very end. What on earth happens to all this debt when the borrower passes away? This is where a little-known but incredibly powerful tax rule called the stepped-up basis enters the picture. Let me break it down. When you inherit an asset, let's say stock from your parents, the IRS essentially says, forget what they originally paid for it. For tax purposes, it's as if you bought that stock for whatever it was worth on the day they died. Just like that, all those years, maybe decades, of built-up profit, poof, legally erased. Just look at the numbers here, it's wild. Let's say our borrower had an asset they bought for $1 million, and now it's worth $10 million. If they sold it while they were alive, they'd have a $9 million taxable gain and owe millions in taxes. But if their kids inherit that exact same asset, its cost basis steps to the full $10 million. Now, when the kids sell it, the taxable gain is zero. They pay nothing, not a dime. And that right there is how the whole strategy comes full circle. The heirs can now sell just a small part of that massive portfolio. Because of that stepped-up basis, they pay no capital gains tax. They use that cash to pay off all the outstanding loans, and then they're left with almost the entire fortune, completely intact, ready to start the exact same cycle all over again. So when you boil it all down, here's the key takeaway. The financial system doesn't really have one set of rules for the rich and another for the poor. What it really has is one set of rules for owners and another for everyone else. The real dividing line is between people whose financial world revolves around income from a job and people whose world revolves around the ownership of productive assets. And that leaves us with a pretty big question to chew on, doesn't it? Is this whole system just a smart way to reward long-term investment and ownership? Or is it really a giant loophole that lets incredible amounts of wealth pass from one generation to the next, almost completely untaxed? Something to think about.